Good morning. Welcome to Trading Hour. I am Reema Tendulkar. With me are Surbhi Upadhyay and Pavitra Parekh. And it's a good Friday morning, right, girls? We're up 170 points on the Nifty. The Sensex has surged close to about 600 points. At the index level, we're up nearly 1%. And with the up move today, we've even crossed the 20-day moving average on the Nifty, which was 17,218. Asian markets are largely buoyant. You've got Hang Seng, which is up close to about 0.6%. A bulk of the up move is coming in courtesy Reliance Industries. Crude prices have gone up, plans to demerge the financial business. And you've got Reliance Industries contributing close to about 50 points to the up move today with a solid 3% rally. But you know, that said, for the last couple of days, markets were fairly triggerless, right? They were just ambling within the tight band. But now there are so many triggers lined up. Today, of course, in the United States, we will be watching one of the markers for inflation. It's called personal consumption expenditure. And that is used by the Fed as a gauge for inflation. So that's going to be out later tonight. Apart from that, next week, you've got the auto sales weekend, auto sales numbers over the weekend. Next week, we will get the pre-quarterly updates from banks and real estate. Plus, we will get a color on IT expectation. Brokerages will be reporting their IT expectations. So that's going to be, crucially tracked. MPC, as we've been talking about, Lata, did that Citizens Monetary Policy Committee. And not to forget, you've got a truncated week. So all that activity is going to be, pushed within just 3 working days, right? So with Tuesday and Friday being a holiday. So I'm saying it's back to local triggers and dancing to local triggers now.
I think the market's just going to be relieved that it's not getting that, hectic volatility and absolute crazy choppiness, which was the hallmark of the last couple of sessions at least. And today's day is very important because we have taken out, and let me use those words with abundant caution, I think I can use the phrase taken out after 3:30. But anyway, for what it's worth, we're trading above the upper end of the recent trading range. This market has been in a band. And I'll talk about the numbers in just a second. Pull up the performance as well. I mean, it is the end of the financial year for what it's worth. So I thought I'll put those numbers on the table. It's been a very interesting ride last 12 months. The Nifty is absolutely flat. It's down by about 1.2%. The mid-cap index is flat. The pain has been in the small-cap index. And a lot of this has actually happened in 2023, what we've seen in the last month and a half or so. It's really the financial services landscape, which is where the money has been made, at least in the fiscal year that closes out today. Nifty Bank's up about 12%, and the PSU banking index, despite the market being in a bit of a winter since January, even then, look at the gains on the PSU banking index. We're talking 35, 36%. So those are the numbers for FY23. Now coming to today's market action, and the reason I'm saying this is a pretty important point at which we are trending or trading, because we've taken out the 400-point trading range that the market was completely trapped in over the last fortnight. Around 13 to 14 sessions that we've been in this band, the lower end of the band, of course, being 16,820, 825, and the upper end being just where we are, 17,220 to be very, very precise. So we're trading above this. A decisive close above this level will definitely encourage the bulls. Very quickly, what are the reasons? Global markets are supportive, as Reema also mentioned. A lot of the year-end adjustment is perhaps done and dusted. It's out of the way. In fact, if anything, there's anticipation that maybe come the new year, come next week, we'll start seeing some incremental local flows really come back into the equity market. We're also looking at a dovish hike from the RBI, like we've got from all other central banks around the world. And last but not the least, the move that started today, if we manage a decent close above the range, then short covering could really kick in, and that could take the market substantially higher. The next zone to track is going to be the 17,500 level. That's the gap that needs to be filled up. We're above the 20 DMA, as Reema mentioned. The next level, 100 DMA, will come in somewhere around that zone. So which is why, Pavitra, I guess it's been a tough last 2.5, 3 months for the market. Yeah. But at least we're ending the fiscal year on a bit of a high with hope that, a lot of this price correction, time corrections, perhaps behind us.
Oh, absolutely. And I'm glad you put up that chart also, right, which shows you the sectoral index move. It's so easy to forget because of what we've seen in the last 2 months, but that, really sums up the kind of action we've seen in the past financial year. For today, it's looking very good. All through this last week, we've been talking about, how the advanced decline ratios looking quite terrible. Today it's looking really good. It's over 5:1 right now on the advanced decline. The small cap index is up 1.8%. So there's definitely, a lot of stock moves that you're seeing in the broader markets. In terms of what's doing very well today, it is the entire defense pack, the railway pack, which are really holding up with good gains. A lot of orders which have come through. We'll talk about that. But check out the move here. BEL is up 6%. You have Garden Reach, which is up over 5%. So very good moves there. RVNL, RailTel, TexRail, just naming a few of the railway stocks, all of them holding up well as well. And then there's lots more specific news which has come through on orders, on expansion plans. So you have Jain Irrigation, VA Tech, Vibhag, all of these looking very good. By the way, the mid-cap IT names are having quite the day today as well. You have something like a Sonata Software, which is up over 4%, KP IT Tech, which is up 3% as well. So this entire space doing well. In terms of the sectoral, indices, it is the metals pack which is holding up the best today, whether you look at the large caps as well. From the smaller names amongst the metal stocks, it is something like a Hind Copper, NMDC, which are seeing good gains. On the downside, what's looking a little bit, relatively soft is perhaps the FMCG space. So you are seeing a little bit of a cut come through there. But all in all, this is a very good looking screen, and we're going to take it with both hands, considering the kind of, volatility that we've seen in our own markets based on everything that's going on globally as well as in the domestic markets. But since we are talking about the markets, let's also bring you some opinion. This comes in from Mihir Vora, who's Director and Chief Investment Officer at Max Life Insurance. Listen in to what he has to say on the way ahead for the market.
I think industry keeps trying that. They keep trying to compensate for volumes by hiking prices. And if the market's good enough, they stick. Not only in cement, but across sectors in the last month or so, we are seeing some signs of even consumer discretionary demand slowing down. See, this seriousness with which the government is approaching domestic manufacturing is here to stay, whether it's in railway or defense. And if we think that defense indigenizations can go from 60% to 75% or even larger, and similarly the way the railways is almost tripled its expenditure in the last 3-4 years. I think the government is hell-bent on making sure that we do things domestically. And we have seen that typically, once the ecosystem in a particular industry develops, then even exports become more competitive.
Okay, that's Mihir Vora's view on domestic demand. He's saying once the ecosystem develops, then we will be able to cater to the export market as well, and that will be another big driver. But let's turn our attention now to some of the big stocks that are moving around in trade, and top of the list is Reliance Industries. Top Nifty gainer, the stock is up close to about 3%, and the company has plans to demerge its financial services business. Sonia is here with the details of this demerger. Sonia.
Well, thanks a lot for that. If you remember, in October of last year, the company announced that they would be demerging the financial services business. Now, this is a business that is growing at a very fast pace. There's a lot of digital disruption that's happening here, and Reliance wants to be in the forefront of that. So now they've gone ahead and initiated the process to demerge the financial services business. The shareholders and stakeholders will be meeting on the 2nd of May in order to take this process forward. After the demerger, the shares of Jio Financial Services, which the company will be renamed to, will be listed both on BSE and NSE. So there's unlocking of value for shareholders, a monetization of its asset, and this is something that the street likes. In FY22, if you look at the numbers, we don't have the last 3-4 years financials. We are awaiting it from the management themselves, but just in FY22, it's a pretty big book that they have. They're sitting on an asset base of almost 28,000 crores. The business had a revenue of in excess of 1,500 crores or so, and this demerger definitely sets the stage for monetization of its verticals, which is a positive trigger. That's what MK says in its note. Now, what does the financial services business have? It has several verticals, including the fast-growing payments bank space. So there's Jio Payments Bank, there's Reliance Industrial Investments, Reliance Payment Solutions Limited, Retail Finance Limited, and Retail Insurance Broking arm as well. Not just that, the important part is once the demerger goes through, in the new entity, none of the contingent liabilities or litigations will be transferred. So the total contingent liabilities as of now is around 1,900 crores. None of that will be transferred to RIL as part of the financial services business. Also, last year when they put the company in place, they appointed a lot of key personnel to grow this business. KV Kamath has been appointed as an independent and non-executive chairman. Hitesh Sethia, who's currently the head of Europe at McLaren Strategic Ventures, He has an experience of over 20 years. He has been hired as the MD and CEO of Jio Financial Services. So there is a lot of scope in growing this business, and now the process has begun for the demerger of the entity. Hence, the stock is well in the green. But standard disclaimer, Reliance Industries is the owner of the channel that you're watching.
Okay, all right. Thanks very much for all the details there, Sonia. That's definitely perking up Reliance today. Biggest gainer on the Nifty and up around 3% odd. Well, that's Reliance. But with that, let's move on to another stock that's in focus today, and that is SBI Card. The stock has been in green after Jefferies initiated coverage with a buy rating. Abhishek is joining in with the details. Abhishek, what is making Jefferies optimistic on SBI Card?
Well, Jefferies has initiated coverage on SBI Cards with a buy recommendation and a target price of 900 per share. They say that the strong franchisee is seen in credit card business of SBI Cards. So they estimate 23% CAGR in spends over FY23 to 26, led by the fact that SBI's large customer base will augur for this growth, and wide co-branding partnership or card tie-ups will also aid in this growth. So net interest margin should bottom out in H1 FY24 and improve over FY24 to 26 as revolver mix. Now, revolver mix is the loans which are overdue beyond 45 days. That is where the credit card companies do make money. That slowly inches up and the rate stabilizes. So healthy profit growth is seen. 23% plus ROE, that is return on equity, is expected over FY24 to 26. The recent underperformance versus Nifty is likely factoring in the net interest margin concern by the investors. So the key risk they say is that there is potential threat from Bajaj Finance and also higher spend share gained by UPI. However, they say that the rise in revolver mix and peaking out of interest rate could be the trigger for SBI Cards going ahead. Back to you.
All right, that is Jefferies calling for a buy on SBI Card. The stock is up 1.8%. But the other space that we're tracking and we were telling you about is the entire defense space, because there have been a bunch of orders that have come through for a lot of the companies. So Vivek is here to sum up all of that interesting action. Vivek?
Well, that's right. So a whole slew of order wins, that have come in yesterday, which been updated by the Ministry of Defense. So first company that we're tracking is Bharat Electronics. Two separate set of, exchange notifications that the company has given. The first one, of course, the company has gone ahead and signed 10 contracts worth almost 5,500 crore. This is to supply equipment to the Indian Air Forces, Indian Armed Forces. The other one, again, is for the Indian Armed Forces. The size of the order this time, it was close to 2,696 crore. Bharat Dynamics is the next stock, which has gone ahead and announced to the exchanges that they have received an order worth almost over 8,160 crore, and this is for the Akash weapon system. Along with that, the company has also received another smaller order of almost 260 crore for supply of helicopters. Now, these are two other companies that we are tracking, Cochin Shipyard as well as Garden Reach Shipbuilders. For both of the order wins that we are discussing, the companies were declared as L1 or lowest bidder earlier. The orders have now been booked. So for Cochin Shipyard, next generation missile vessel that the company will be supplying, this particular order is worth almost 9,800 crore, and Garden Reach Shipbuilders has booked orders worth 3,600 crore for 4 offshore petrol vessels. So slew of order wins is keeping the entire defense space abuzz today.
Oh, absolutely. It's a 4 to 8% up move that we're seeing on these stocks. Vivek, thanks a lot for taking us through all of that action. But with that, let's also invite our first corporate on trading hour today. Quest Corp saw an 11% up move on Wednesday. It's up once again today as well. This after promoters of the company picked up a significant stake by means of reverse book building. So to discuss, we're joined by Ajit Isaac, chairman of Quest Corp, to take some questions on this. Mr. Isaac, thanks a lot for joining us today. This is Pavitra. If I can just begin by asking you about the holding structure right now, if you can take us through what the Isaac family's total holding is, what Fairfax's total holding is, and of course the reason behind, upping your stake.
Sure. So the promoters together, Fairfax and me and my family together, own about 56.5% in Quest today. We've added about, let's say, about 5.5% in the last 1 year or so between the two of us. Fairfax has been investing in India for the last 20 odd years and has a very large book of assets in India, in excess of maybe $7 billion. They're very familiar with the India landscape and the opportunity that India presents. We think that the best of Quest is coming up in terms of the changes that's been made, the assets that we're holding, and the changes in the EPS that's going to come in the future. So I think it represents an opportunity for all investors to ride this process of change that's at Quest.
Mr. Isaac, morning. Rima here. Are you or is Fairfax keen to increase your holding beyond the current levels? Is there a target that you have in mind? Because now it's the new financial year, so you can go ahead and further raise stake via the creeping acquisition route.
So we have an opportunity to do it in the next year, but I don't want to speculate on what we could do for the next year coming up. But suffice it to say that I think we see a good opportunity at Quest because there's a large formalization process in the labor force that's taking place. People are moving from the informal sector to the formal sector. And in fact, at Quest, out of the 350,000 people we've got, close to about 145,000 have got UAN numbers for the first time after they joined us. So clearly, we are a starting point for employees as they start their professional careers in India.
Mr. Isaac, good morning. So, since obviously you're quite optimistic on the business, what's the thought process? Is there a specific level that you have in mind that you would want to take your own shareholding up to as part promoters? And I don't know if you've had that discussion with Fairfax. Could we see you or them keep on increasing stake in the listed company?
So, as an individual, I have an opportunity to go up to 25%. Without triggering the creeping acquisition norms. Depending on the opportunities that come, we will take a decision and cross the bridge at that point of time. But as of now, we're happy where we are.
Okay, as of now, happy where you are. Mr. Isaac, I'm going to move on and ask some questions about the business as well. Because, we were looking at the revenue growth. It has been coming down from around 33% that you had in Q1. It moved to 32.4. And then in Q3 of FY23, it was around 21. Can you tell us what is the trajectory there? What is the kind of expectation you have for the coming financial year for FY24?
Sure. So let's look back a bit over the last 5 years and then look at this year and then the last 2 quarters. If you look at 18 to 23, our headcount sort of grew from about 250,000 to about 5 lakh. So we've had a CAGR of almost about 20% from 18 to now. In the first half of this year, the economy was growing faster. Employment is largely a function of how the economy is doing, and the IT segment lost a lot of its momentum in the second half. So I think it's fair to say that this is a cyclical change in employment. Quest is affected by that. But from the changes we see in the market, we expect Q1 to be a little better and picking up from there. But even though headcount has grown only by 20%, our revenues have actually grown by 22%. In excess of the headcount. So that's a significant part of our story as well. That revenues are growing faster than headcount. And lastly, our IDC is also coming down. Our IDC, what is potentially at about 8.5% sometime back, dropped to about 6% last year. And next year, we expect it to be about 5.5 to 5.7%. So there's an increase in revenues. We think revenues can go up by between 15 and 18% for next year, and a drop in IDC as well.
So FY24 revenue growth is 15 to 18%, right? That's the guidance.
That's what I think we would be all
right. Okay, just getting specific about IT, because that's where the pressure is. Has Q4 staffing for the IT segment been as bad as Q3, worse or same? Just some numbers, or has it improved?
So the Q4 numbers are not yet complete as of yet, because the third month's numbers are yet to come in. From what we've seen of Q1 and Q2, mostly it's only been replacement hiring and no incremental hiring in the industry. The services segment has been the most hit. Captives have performed better than services segment. Product, SaaS, and the internet businesses have also been subdued. So I think we should expect Q4 to be in line with what was in Q3.
Okay. Mr. Isaac, just a word on your efforts to shore up margins, which have been, on the lower side between 3 and 4%. I mean, they've trended closer to 3 than to 4 in the last couple of quarters. And I believe you had roped in BCG for, some kind of strategic initiatives. So what's the progress there? And do you see some tangible impact? Can you give us some sort of a tangible guidance in terms of by the end of this exercise, how much can the needle be moved on the margin profile?
So what it will result in will be in a set of actions that the management has to take over a period of maybe between next 12 and 18 months time. So the results will play out over a longer period of time. But having said that, our goalposts are clear. We want to reduce our IDC. We want to increase our margins from, we were at 3.2, 3.3 in Q3, aiming to go up to about 3.5, and then thereon from there to about 4 to 4.5. So if we can stabilize at about 4 to 4.5, I think it's a good margin rate for a business services company. In addition to increasing margins, we also have to work at a DSO. Our DSO is currently at about 62 days. I think if we can lop off about 2 to 4 days from that, that will increase the amount of cash coming into the company. So these are two specific actions that we have to take in terms of operations. The third one is in terms of the shape of the portfolio that we've got. There are some assets that we may want to monetize. We've already monetized one asset about 6 to 8 months ago. We may do a couple of them again over the next 1 year's time, and that will again change the way our portfolio looks. Lastly, Monster has had a peak burn of 100 crores this year. So depending on whatever EBITDA we finish at this year, it will include a 100 crore burn for Monster, which was not there previous year. So that will come down for the next year. It will come down to almost half of that for the next year. And that will therefore add that much more profits to the company. So all of this together will increase our EPS significantly for the next year.
So you're targeting to go up to about 4.5. That's sort of the objective over the next 12 to 18 months. You mentioned asset monetization. So what is this monetization pipeline like? I mean, is there a value that you have already ascribed to it? And is there any asset that you have closed in on, which perhaps could be first off the block, say, in the next 1 to 2 quarters?
This is work in progress. The BCG assignment will get over only by maybe the middle of May. So it will be a clearer picture on which of the assets that we would like to monetize will emerge by then.
So is there any EPS growth that you have in mind? Because your top line will be growing at 15 to 18%, but there will be margin expansion. The cash burn in Monster will come down by half. So what will this mean in terms of an EPS growth, according to you?
So we think that there is a potential to grow EPS between 30 and 40%, at least in the year coming up.
All right, Mr. Isaac, we're going to leave it at that today. Thank you very much for taking out the time and speaking to us about this recent, stake that you've picked up, as well as the outlook for the business. That is the management of Quest Corp telling us that the promoters now own 56.5% in the company. For now, they're comfortable with that. They're not looking to, increase the stake right now. As far as the revenues go, they're looking at 15 to 18% for the coming financial year.
EPS or a profit growth of 30 to 40%, right? So that's quite significant.
Quite significant there. And he's sounding very positive on the business as well, although of course there are pressures in individual segments like IT, like you mentioned. So that is the management of Quest Corp. We will get into a short break with that, but on the other side we're going to shift focus and talk about commodities with Manisha.
Okay, Mark, let's shift the focus to the commodities universe. Now, Manisha Gupta is joining in, and today she is focusing on rubber. Manisha, hi. So what's moving in the rubber market?
Well, thank you for that, Surbhi. We are trading at a 3-week highs when it comes to the global rubber prices. For the Indian markets as well, it has been a good going. We're trading at around 138 rupees per kg here. The data and the economic numbers from China have been on the positive side, and there are statements from China which says that they are making effort to stabilize automobile as a sector, also consumers, electronic consumption, and that is where rubber is used. And we have seen most industrial commodities actually taking support from that. Also, when you look at the Malaysian numbers, the natural rubber output in the month of January saw a decline of 39%, with an expectation that the quarter also could be ending in the negative there. Also, there is a report from Association of Natural Rubber rubber producers, which says that for the month of Feb, while the global production saw an increase of 2.6%, the global consumption has seen an increase of 7.3%. So clearly, supply has not been able to keep up with the kind of demand growth or demand return that we've seen in the international markets there. Also, an interesting data coming in from ICICI, which says that the overall global demand for natural as well as synthetic rubber for this year could see a jump up of 2.8% on an year-on-year basis. So whichever way that you look, the rubber price is clearly in flavor.
Thank you very much for that, Manisha. Get into a break. On the other side, we'll be back to discuss the IT sector with Apurva Prasad of HDFC Securities. Welcome back. 17,250 on the Nifty, up 178 points. The gains are all intact this Friday morning. The indices have surged close to about 1%. But let's turn our attention now to the IT space. Now, HDFC Securities hosted 15 IT companies at their 7th annual IT conference. To discuss the key takeaways from the conference, what we can expect when the Q4 earnings begin in the following week from 12th of April, we're now joined by Apurva Prasad, Vice President of Institutional Research at HDFC Securities, on the show now. Apurva, if we could start this conversation by you giving us a broad synopsis of your key takeaways after talking to 15 companies.
Sure. Thanks for having me. So, Rima, some of the broad pointers that came about, and this is right in the middle of some of the recent macro events that were turning. So, the sense that we got is there is some caution in the near term that most of the companies did highlight. The degree would vary according to companies, but nevertheless, there is some element of caution for near term. This is a 1 or 2 quarter specific time horizon is what I'm referring to. At the same time, the medium-term outlook on the sector in terms of the tech transformation cycle, that continues. So I think that was, again, a common message across all companies. The third point would be on the Europe side. So there was a lot more pessimism about 3 to 4 months back, and this was a period when concerns on the harsh winter and gas prices, and things have certainly not panned out as feared. So from Europe versus what was feared, the outlook is relatively better. And then the fourth common thread would be on margins, I would say, is there is some degree of upward bias to margins that companies are looking at, be it in the form of cost optimization or in the form of rationalization of some of the other costs.
Apurva, hi. Let's take up the first part of what you just spoke about. I think the concern on demand, because that is pretty much what everybody is grappling with right now, whether there's going to be delay in decision making. Yes, the banks aren't blowing up anymore, but whether there'll be just more sort of hesitation on part of a lot of the North American clients to sign the checks. What is your sense? And in terms of at least the fourth quarter, headline growth, constant currency headline growth, who's supposed to be the best performer and who's sort of relatively poorer off in terms of the companies under your coverage?
So within our coverage, we still expect TCS and Infosys to be at the top end on a relative basis. It would still be muted relative to what it's done historically. But yeah, from a growth standpoint, look, there are 2-3 factors at play here. So while you have slowdown in decision making and leakage between bookings to revenue, and at some stage between the pipeline to bookings, so I think the offset to that is that companies are going after a much bigger pipeline. So there's a lot more focus on going after the EN business, existing logo bounds, the new business within existing logos. So that's the segment that most of the companies are going in. So I think the offset is really coming in for that. So yeah, while it does mean sort of mixed outlook in the near term, but the trajectory improves over a period of time, because let's not forget there is some pent-up element to the fact that there is leakage between bookings and revenue. So I think a lot of it is something which could come back potentially in H2, and that's something we.
Okay, Apurva, good morning. Thanks for joining us. Can you tell us what you're hearing on the deal wins? Because, it seems to be quite mixed. Like on one hand, you hear Sonata has picked up its biggest ever order. On the other hand, you have, some of the other companies telling us that they're not getting tech budgets for the entire year at one stretch. It's coming month by month, or it's slowing in that sense. What are you picking up on the deal wins for the large cap names as well as for some of the mid cap IT companies?
The deal bookings actually would be quite strong. They were tracking very well in January and February. And if you look at some of the deals that have been reported already by the IT companies, the bookings number per se, the TCV numbers are going to be strong. What that, however, may not translate into an equal, growth acceleration because the deal durations are much higher in this. So which is what I meant earlier, between the TCV to ACV conversion, those would be lower. And so you're looking at a scenario where despite TCV, which may look better, it may not translate into a growth acceleration. We saw that, in Accenture's recent result. So we see a similar kind of a trend playing out where the bookings number per se will not be a problem.
Apurva, just for this quarter, what do you think the guidance will be by Infosys and HCL Tech in terms of annual numbers?
We yet to put out our preview estimates on that, so we probably communicate that. But then it's going to be a material deceleration from 16% where it should be a high single digits.
And for HCL Tech, also it'll be high single digits, according to you?
That's where our estimates are currently. Yeah, so we do expect that.
And have margins bottomed out in your estimate?
Absolutely, Rima. So I think that's one big driver for the acceleration in earnings growth. So if you look out for FY24 earnings growth or profit growth, it's significantly better than what the companies did in FY23. And a big part of that is margins normalizing. So they're sort of recouping from the impact, which was more around attrition and some of the cost of delivery related factors. So I think that is something which is coming out and which is why we think the profit growth for the sector, which is down to 6-7%, 23, that will go up to low teens. That's what we're looking at. And a big part of that is margin recovery.
Okay, so the top line growth will be in high single digits, maybe 7 to 9%, 8 to 10%, but the bottom line growth, the EPS growth, will be in low teens. Is that correct?
That's correct. That's correct.
Okay.
Okay. Just want to get to some of your buys as well, Apurva. You have a couple of mid-cap IT names that you seem to like. I mean, there are lots of ads, but I'm focusing only on the buys. Memphasys and Persistent are those names. There's Cyient, there's I think even Sonata, there's Zenza. So you seem to be liking the mid-cap universe quite a bit. I know we're a little crunched on time, but just maybe if you could take us through some of the key thought points here. And why are you going in for these mid-cap IT stocks?
Sure. So there are 2-3 factors. So one is visibility of near-term growth. I think so. It's a tick mark on that. 2 is the possibility of upside risk to growth, and 3rd is the quantum of growth. So I think the growth premium for some of these companies, and I'm referring to Persistent out here, which is box in all these 3, would continue. Some of the other companies would also be a function of where the valuations are. So it's a combination of that. But yeah, our primary reason for backing the mid-tiers is growth premium relative to peer set, as well as valuation comfort on a peg basis. These would be some of them.
And is growth also the reason on the biggies you're preferring an Infosys to a TCS?
That's correct. So we believe that the growth premium of Infosys versus TCS can continue. The margin gap may not sort of come down. But yeah, on a peg basis, it continues to be more attractive. If you look at long-term averages, FY25, it's actually now gone lower than the 10-year long-term average. So I think, yeah, the valuation point is also very valid in case. But we do have an ad.
All right, Apurva, we got that, and we're going to leave it at that today. But thank you for joining us and taking us through your call on the sector and some of these individual names within the IT pack as well. We're less than 2 weeks away from the earnings, and we also, Rima, did get a little bit of a tease from Accenture, but I think 2 weeks and then we'll know what it's really looking like for the IT pack. So we are going to get into a break on that note, but when we come back, we're going to shift focus. We'll get you a technical check on this market. Ashish Kayal of Wave Strategy will be with us. Welcome back. You're still tuned into Trading Hour. There's no stopping this market today. Almost full 200 points higher on the Nifty right now. So over 1% in terms of, again, 1.2% to be precise. So it's only moved higher in the past few minutes. Like you can see, the broader market also holding up very well. So the mid-cap index is up over 1%. The small-cap index up almost 2% right now. And check out the banks. Led by the private banks today, you have the entire index, which has seen a near 600-point uptick. So that is for the Nifty Bank, looking very strong. And the advanced decline at 5:1, like we were pointing out. So let's get Ashish Kyal in to get us a technical check. Ashish, that's a good-looking screen that we have today.
Yes, indeed. Nifty, after many weeks, if you check, it is managing to take out the prior week's high, and it has not happened after, I think, around 10 to 12 weeks. And that's a very positive sign. And the good part about it is led by the big boy Reliance. And it looks like there is not going to be stopping anywhere soon. So I think the overall undertone for Nifty, Bank Nifty has turned on the buy side after some time. And this will be the much needed relief rally from a lot of people who have been stuck at the higher levels. Over here, as long as the gap area that we can see is intact on the downside, I think Nifty can head towards the level of around 17,400, 17,420 eventually. So use any dip as a buying opportunity. On the downside, the support is around 17,130 levels, which is the gap area. As long as that support is intact, aiming for the target of around 17,420 on the upside.
And stocks, Ashish, what would your recommendations be?
The first stock is Reliance Industry itself. We can clearly see a very strong rise that has happened after forming a double bottom near around 2,200 levels. And the stock is managing to even cross above its 20 days and the 10 days average, looking like it is going to be heading towards the level of 2450. So long positions can be created here with a stop loss of 2240 for the target of 2450. And the next stock on the buy side is going to be Oro Pharma. We can see some traction in the pharma space, and Oro Pharma has shown a very strong and sturdy rise over past 2 to 3 weeks, and looks like there is more steam left on the upside in this stock, possibly the third wave going on, aiming for the target of 556 on the upside for Oro Pharma. Maintain a stop loss of 500.
Okay, all right, got that. Ashish, thank you for joining in with those trading ideas. We'll take a quick break on that note. On the other side, we'll discuss market fundamentals. Satish Ramanathan of JM Financial Asset Management will join in. Welcome back. The market is steady as she goes. Absolutely no sign of volatility today, and that's something of a bit of a novelty. We're very close to the highs of the session. There's been no selling at those higher levels, at least not as of now. Well, a good time to bring in Satish Ramanathan, who is the CIO at JM Financial Asset Management. He's joining us on the show to talk about the approach to this market now. Satish, thanks for joining in. Speaking to you when the bulls are definitely in a very, very good mood today. And after a long time, right? It's been a trying market last 2 odd months, the start of this year and actually even 2022. So you tell us, what have you been buying in the fall, if anything at all? And what's the preference? Growth, value? What are the bets that you're looking for as the market goes through this consolidation phase?
Yeah, we've been, thanks for having me on board. Thanks for that once again. And we've been growth oriented throughout this cycle because we believe that growth is the way to go, especially in a developing market like India. And we focus on companies that have growth potential, and we have stuck to that philosophy. As regards the market itself, it's been trying, yes, primarily because of the issues that we've seen in the West and their ability to control inflation being challenged from time to time, and liquidity drying up. Fortunately for India, I think we have a strong savings pool and money coming in from the domestic savers, which has actually kept the markets far more robust than other emerging markets.
Satish, morning. Thoughts on defense? We've seen a slew of order wins in the last couple of days, particularly. I think there is an ICICI security note where they say that in the past 1 week, the Ministry of Defense has placed orders worth 44,000 crore rupees, thus boosting India's indigenization efforts towards defense. And this has been ongoing for the last couple of months. It's just that it's picked up as the financial year comes to a close. Now, the question is there more upside in the stock? Because these defense stocks, the BELs, BDLs, Guardian Marine, Reach Shipyard, etc., they've been in an uptrend for the last 1 year or even more than that. So is the best of the up move behind us? Have the stocks priced in that for the next couple of years, these companies are going to see strong growth?
I think the growth potential is very much intact. As regards certain stocks may have had reached a peak valuation and then cooled off subsequently. But if I take a 3 to 5 year time frame, I think the growth potential is very much intact. The direction of the Defense Ministry is to localize, and which would mean that all of these companies benefit. And there are private sector participants also who will also benefit just as much. So I think apart from the pack on the PSU side, we will also see beneficiaries on the private side.
Okay, got that. Satish, good morning and thanks for joining us. Are there any other sectors that you've identified which you feel now after this correction that we've just gotten feel perhaps more reasonable and the valuations feel comfortable to you now? Are there any such sectors that you've identified?
I think if you look at the recent correction on a 3-month and a 6-month basis, almost 40% of the market has corrected about 10% or more. And that gives us an opportunity to actually pick up good quality stocks, meeting our philosophy and building up our portfolio. Now, in terms of the stocks, we are fairly stock specific and not too much caught up on the sector. We find manufacturing actually doing reasonably well, and it has played out through this crisis. Capacity utilization has gone up. Some of the sectors like auto ancillaries are doing reasonably well and holding up. So we are looking at sectors and companies where it's not really macro-based or global-based, but the outsourcing opportunity of India remains a very powerful theme. And we are focusing on those kind of companies to grow.
Okay, so you've spoken about the auto sector. I'm coming back to the original point where sort of we started, and that's you said that you've been looking out for building a more growth-oriented portfolio. So apart from auto, what are the areas of the market, the pockets where you find a lot of interest? And right now in the portfolio, what would be the top holdings, at least in terms of just a sectoral or thematic play if you can't talk stocks?
So we are slightly underweight on financials, primarily because we believe that there are better opportunities elsewhere. And what we have done is we have directed some of these assets from financials into the manufacturing space. And it is across a slew of companies. We hold Bharat Forge, we hold Larsen & Toubro. So all our portfolios are public, and we hold all of these names because we believe that their growth potential is significant.
Just a follow-up, that's interesting. So you've diverted some of the money from financial services to manufacturing. You mentioned 2 names, but that's a pretty large chunk, manufacturing as a whole. So again, what part of it are you looking at? Capital goods, road companies, power? If you could give us some more details.
In general, what we have found from our research is that capital goods are very efficient, and they actually generate a lot of free cash flows when the cycle turns for them. And consequently, our preference is for cap goods. And valuations are running a little ahead of the fundamentals. So as and when we get better opportunities, we would be actually looking at those kind of businesses because we are globally competitive. We have an export play and a domestic play all built in.
Okay, got that. Satish, just one final question. Have you looked at any of these new age companies, and do you think that any of them seem attractive to you?
So the new age companies, what we believe is that as and when they do turn profitable and cash flow positive, they become very much viable, and they would be then evaluated on their merits and growth potential as also their cash flows. As and when we see companies turning profitable, we would look at it seriously. But having said that, I think the growth opportunity in the new age companies cannot be challenged. We think that they do offer a very high growth potential, but it's just that they have to prove their profitability from time to time. And that's when we would actually be interested in looking at these businesses.
We'll leave it to that. Satish, thank you very much for joining in. That's JM Financial for you. Get into a break. On the other side, we'll get you more on the markets.
Welcome back. You're still tuned into Trading Hour. It is a full 200-point gain that we are seeing on the Nifty, like we've been pointing out, so holding very well there. The Nifty Bank is also absolutely steady with a near 580-point gain. And, you know, like we were telling you, some of the larger names which continue to be in focus and are doing well today, of course, Reliance is topping that list. You have a lot of the banks doing well. And in the past few minutes, you have IT, which has really moved up. So take a look at Infosys. It is at the high point of the day. That one doing very well. Tech Mahindra has moved up. So keep this entire space in focus. Anyway, you know, we were talking about a lot of the mid-cap IT companies doing very well and holding up. So that is those are some stocks that you should watch. But, you know, it seems like it is a good day in terms of news flow. And there's also a big upgrade that has come through for India from Morgan Stanley. So Sonia standing by at the big wall to tell us all about that. Sonia?
Oh, absolutely. Thanks a lot for that. So as you rightly pointed out, Morgan Stanley has gone ahead and upgraded India to an equal weight. That's a report coming in from Jonathan Garner of Morgan Stanley. And there are several reasons for this upgrade, but the primary reason is that the valuation premium compared to its peers has been narrowed. India looks like a very resilient economy because it was not impacted by what happened with the SVB crisis. And Morgan Stanley is very bullish on the structural growth outlook for the Indian markets. Now, what they do say is that the growth will now be driven by a combination of factors. One of them is the digital infrastructure empowered lending boom, the demographics, the domestic demand, and an improving FDI situation. Now, they also stay overweight on other markets in Asia. They're overweight on China, Korea, and Taiwan. And they say that the financial contagion or the expected contagion should be limited across a lot of these markets because of relatively strong liquidity and capital positions. The only market that they have downgraded is the UAE financial market. They've downgraded it to an equal weight. But coming back to the Indian market, since they are quite bullish, we drilled down into the report to see which are the sectors that they like. The focus is largely on financials and consumer discretionary sectors. They have turned constructive on consumer discretionary and on healthcare as well. They say that the uptrend in India's economy will definitely stimulate consumer spending going forward, and the consumer discretionary sector is a direct beneficiary of higher inflation, higher income, and likely abated inflation. So these are some of the reasons why Morgan Stanley is quite bullish and has upgraded India to an equal weight. Back to you.
Okay, all right, Sonia, thanks very much for those details there. So that's good news coming in from the Morgan Stanley stable. We will wrap it up on that note of Trading Hour. Do stay tuned. Halftime report coming up next.